Here's a school book example of term structure. Here you're looking at two graphs. One is of the Arabica coffee market, the other one of the lumber market. On the Arabica coffee, you see that for each different delivery, the price is a little bit more expensive. Now, keep in mind here, what the graph shows you is price on one axis, expiry date on the other, and each dot represents current price for a different deliverable of the same market. So we're looking at the March coffee, we're looking at the June coffee, September coffee, and so on. Each one goes a little bit higher. It's a bit more expensive in the future. That pattern, the first one, is called contango. The opposite, as we see in lumber, each contract is priced a little bit lower the further out you go in the future. That's called backwardation. Now, I have read multiple theories about where these words come from, but I have no idea which one is true. They're just ridiculous words, I guess we have to live with. These two patterns are here, the school book versions. Often it's not so clear cut. They might go up and down, back and forth, but often it has a slight tilt in one or the other direction. And this really matters. Now you might ask, why are the prices different? The most common guess would be that the higher prices, say in the coffee market here, represents investors' belief that the price of coffee is going up in the future. That's not how it works. The truth, I usually say, is pretty irrelevant when we're dealing with quant trading, because we're not in philosophy, we are just simple people trying to make money. But if you're looking for some sort of explanation, the closer to reality has to do with hedging costs. So if you want to hedge a position without the futures, you would, in the case of coffee, you need to buy a large amount of physical coffee, meaning you need to finance a position, you need to arrange for transport, storage, delivery, and so on, and that costs money. This hedging cost is called the cost of carry, and that explains the price differences. More important for us as quant traders is, what does it imply? What does this mean in terms of price analysis? And this graph, I would say, I'd probably argue that this is the most important slide I have. So if you want to take a screenshot of one of them, this is probably the one. Now here we have a theoretical example. The middle line is a theoretical underlying asset, gold, oil, whatever. If the futures based on this theoretical asset is in contango, the price of the future will initially be above the underlying, as we see in the upper graph. But you see here how it slowly goes closer, and that is because by the time of expiry, the contract price will have to be the same as the underlying, because at the time of expiry, the futures is settled against the underlying. So we know that these two lines will meet up in the end. So if you think about that logically, that means that the further away from the price it starts, the more it has to move relative to the underlying before the two lines hit each other. The same goes, or the opposite rather, for backwardation. A backwardation contract will start out below the underlying and slowly move closer. So in this case, we have an underlying that moves up and down. As you see, if the underlying moves enough, then a contract in backwardation can lose money, and a contract in contango can, well, both contracts can lose or gain money, of course, because the price of the underlying is still a driving factor. Here I made an example where the underlying ends up at a similar level to where it started. So it's not the only factor in determining the direction of the price, but it is one directional force to take into account. And this is what this graph, what this slide wants to show you. If you imagine a theoretical situation where the underlying doesn't move at all, it's completely flat, year after year, it doesn't move. Well, then we know with mathematical certainty that each futures contract, wherever it starts, contango backwardation, will slowly move with an equal amount every day, closer and closer until it finally hits the underlying. This is what term structure is. So if you understand this, then you see that contango has a bearish bias and backwardation has a bullish bias. That's something to keep in mind. Of course, looking at the chart, just looking at these graphs is not going to help us that much because we need to quantify it to be able to test if it works or not. I'm not a fan of just looking at a graph and making a judgment call because, well, you never know what's going to happen. It's very easy to imagine things and very difficult to compare things. So if we dismiss simply looking and seeing if it's a backwardation or contango, the first two things that come to mind is we can look at the price difference in dollars or the price difference in percent. Neither is going to work that much because those numbers are not comparable across markets, across, well, anything really. And the solution, at least the solution that I prefer, is to calculate implied yearly yield or annualized implied yield. This means calculating the difference in price, taking into account the difference in days, and making a yearly equivalent value. Here's an example with corn. Here you see the term structured graph, and you see the table. So we look at the price difference of each contract compared to the first contract. We're looking at how many days difference in the expiry. And based on that, we can annualize the number and end up with a yearly equivalent number. Now we can compare that across other markets. We can compare the implied yield in corn to the implied yield in palladium, for instance, on an equal basis. I also included here a table with open interest because I wanted to make the point that liquidity greatly decreases further out on the curve. So when you implement this type of strategies, you need to be very careful with liquidity, especially if you have a large trading portfolio. So it is after all a quant speech. So here is the obligatory formula. It's a very complicated one. I'm sure you've seen this one in high school economics. How do we annualize a number? Well, in this case, we take the price of contract 0 divided by the price of contract 1, raise it to the power of 365 divided by the date difference, take away 1, and now you have your annualized number.